Hey guys, welcome back to the channel, and on today's video, just giving another market update as we usually do in terms of what kind of markets are heating up, cooling off from a capital growth and rental perspective, but also some previous purchases where we're buying. It's a pretty common question we get here at Ripe House, so let's just jump straight into it. So if we get into the capital growth to begin with, we go kind of line by line. Sydney went up 1.9% in the last month. 9% over the last 12 months. So that Sydney market's really continuing to heat up there. Just a slight change since our last update that we gave. The Melbourne market, and like I said in the last video, I feel like the Melbourne market's lagging a little bit. It's a bit of a tale of two cities. There's some pockets that are well above and absolutely soaring, and maybe more expensive areas not popping off as heavily. But 0.5% in the last 12 months. Just under 5% over the last 12 months, but there's been a big change since the last 1.7% since just the last update. Again, if we go into your Brisbane, Perth and Adelaide markets, they're still in double-digit or close to double-digit territory. Perth has probably cooled a little bit more, or it has cooled a lot more in the last month, where your Brisbane and Adelaide markets have actually picked up, but there is still a bit of a drop-off since the last session. It is to be expected, though, given they've come from such a high base, unachievable numbers to sustain. Again, there's no signs here that they're panic selling for anything like that, but just something to be aware of. Canberra market, we don't really care about Canberra market too much. We don't buy there, but again, in the last 12 months, about 6.3%. Big uplift since the last session. Good change in the last 12 months. Darwin is a bit of a, maybe potentially a bit of a concern again. For us as a business, we have talked about it on previous videos. It is a market where some buyers agents have kind of come in and bought there very heavily. For us, we just will not buy there. There's a few factors why we wouldn't. We don't think it would, push mania buying like you've seen maybe historically in the previous years in Adelaide, Perth and Brisbane. It might be a smash and grab kind of job. I think there's a few risks you're buying into that market. Might be a bit of a pump and dump scenario. Has seen a lot of growth over the last 12 months, but a big change since the last session, 4% drop, and going back in the last month. Hobart is one, which is also an area for us which has now moved into an approved location. It's in our buying window now in the Ripe House team, and it is earlier into the market, not too dissimilar like when we were speaking on here 12 or 18 months ago about coming into buying into Victoria. I would say that's where Hobart is probably sitting, maybe a little bit further past, but up 7.8% in the last 12 months. Bit of a drop off last month, pretty minor number, 0.2%, but up since the last session. Nationally though, if we talk about across the board, the whole market's moved up. We're up nearly 1% for the last 12 months, last month, I should say. For the last 12 months, we're up 9.5%, and since our last session, 1.4%. And I guess from the buying side, speaking with our buyers agents, it is getting far more competitive on the buying side when putting offers through. I would anticipate that to get far worse from here. We've seen the first home buyer scheme pushed forward, but also too the cap numbers come up further from January. So that's probably likely to push that national average higher. We can see here the regionals are performing a little bit stronger with the capital city average similar last month rolling change, just under 8% for the last 12 months. But again, 1.9% change since the last update. So that capital cities are now starting to move across the board. When we get into the rental growth numbers, we can see pretty healthy numbers though still. We're obviously expecting a bit of a slowdown with interest rate cuts have happened now. I've had 3 rate cuts potentially. I don't know if we get one more this year, maybe from February next year, because I don't think the board sits in January anymore. But what we're seeing, 4.5% in Sydney, 3.3% in Melbourne, Brisbane, 7.5% over the last 12 months, big uplift in just the last month alone. Perth at 4.7, Adelaide starting to slow down a little bit more at 1.8, Canberra at 2, Darwin starting to go backwards. So that's not normally a healthier sign, what we want to see, but could be an outlier of a month. Just we'll double check that in the next update, but went backwards. Hobart has been pushing forward strongly. So up 12% in the last 12 months alone. And again, what we do like to see is that rental pressure coming through. So that's, again, another healthy sign there for the Hobart market. Nationally, you're at the 4%, and at a capital city average at 4.6%. So again, ticking along that 4 to 5% marker, which is the norm. Previous years have been double digits, pushing 20%. So that's not the normal. We're more in the normal territory right now. But I guess the key signs there that Sydney keeps creeping forward. Perth, Brisbane, and Adelaide are just starting to ease again, and Darwin is potentially cooling down as fast as it heated up as well, but it's more of a wait and see. When we get into a bit of a breakdown in terms of where we've been purchasing, so no really big fluctuations there. We've got Victoria making up a lion's share of our purchases at 72%, Queensland up at 14%. We've had New South Wales pick up a little bit. We're at around that 8% number there. We've got Tasmania and WA making some small purchases. Now, I do think the Tasmania side will slowly pick up for us. Again, it's not going to be something that's going to make a huge portion of our buying wheel. And that's just purely going to be about opportunities. The population of Tasmania is around 500,000. Just the amount of properties available for sale at any given time, you're just not going to get that in the similar market that you might see in a Victoria or other states. But it is an area of interest that we've now got more locations in Tasmania in our buying window as well. So a bit of an interesting one there as well for future months. In terms of purchase summary, median price point down just ever so slightly last month. That's going to be, again, led heavily by clients' budgets. So one thing that we do here as a buyer's agency, we don't just pass on properties and force on the client to buy that property. It's got to work within their budget and personal criteria, as well as matching data and due diligence checks. So the median price there at 541 had the median yield at 4.9%. So we touch on that. That yield is probably going to further compress across the country because we're seeing it there. We've got capital growth close to 9% across the board, but we're only getting 4% on the rental return. So expect more of a rental yield compression as the months go on. We've got the median build date of the properties we purchased at 1975. And look at that land size. We talk about shrinkflation in some other products. Your average land size on new developments, you go out there, a 400 square metre block is what's considered one of the bigger ones. We were at one of our staff mentioned he was at a party over the weekend, and someone he was speaking to there had just purchased a brand new house and land package, and he had one of the bigger land developments in that area. It was around 310 square metres. So what you're getting when you're buying these established properties is immense bang for buck on that land asset to land value ratio, 674 square metres. You just won't see that on the new developments coming through moving forward. The developers could turn that into 2 blocks and get double and basically charge nearly the same price for one. So they're just going to continue to shrink that down, and you're going to have less of a backyard. They'll get you to go play in their park in the estate, be real Truman style type of build outs, what you'll see in these suburbs that keep developing moving forward. Now, a big question we get is recent purchases, just maybe some examples. So I thought it might be helpful I run some recent examples on the video today. So we've got a regional Vic purchase. We always get questions in terms of, are you still able to buy properties under 400,000? Now, admittedly, it is very, very tight to buy properties under 400,000. It makes up a small amount of our purchases. But if we take a look here, this is a regional Victoria purchase, 3-bed, 1 bath. Won't get too much into the car spaces because that's obviously always going to be up to debate what the agent terms to deal as what's a car space or not. But we're on over 600 square metres of land. We purchased the property for $336,500. Rents at $340 a week, so we've got a really healthy yield of 5.3%. But we can see there, if you're buying at this price point, you're not going to be buying something that's flashy and brand new. But I would say with almost certainty, I can't see why this property is not going to get a really fantastic return over the next 12 to 24 months when you're buying at that price point. First home buyer market, 5% deposits, that's just going to push the prices in these type of assets through the roof from a percentage perspective. Coming up scale, we're going into Metro Melbourne, over just $1 million purchase here. Again, a bit more of a modern build. You've got a 4 and 2, looks like a 3-car garage, 700 square metres. the rent is $725 a week. But when you get into those metropolitan locations, you're not going to be getting yields in the 4s and 5s. You might just touch the 4s, but it's going to be very low 4s or likely high 3s. And this is a good example of it here on this type of asset, 3.75%. But I mean, if you look at the property, it's probably going to be a bit more of a set and forget asset. There's obviously depreciation on the property given the age of it as well. Does bump up that rental yield as well. But if this is the type of asset where you've got somebody who wants to be a hands-off investor, that'd rather be in one property as opposed to managing 2 or 3, again, it's got to match the investor profile. There's no such thing as a magic price point that's going to perform better than everybody or fitting everybody into the same hole. It's got to fit the investor profile as well, which we're big advocates for. Then we're going to a different purchase, another state, regional Queensland, 3-1, really large block, 780 square meters. Look at the, again, I do touch on this a bit. The advertised price is irrelevant. It is just purely a marketing tactic. Sometimes you're going to buy at the advertised price. Sometimes you're going to be above. Sometimes you're going to be below. It's not like it's a retail product where the price is the price. It's purely a marketing tactic. And in this instance here, had to buy at $541. Numerous offers on the table on this property, renting out $500 a week. Rental yield just under the 5s, but we can see older property clearly being renovated, fairly modern kitchen and bathroom. Again, going to be a great investment, great land to asset value ratio there as well. But that's everything we needed to cover off on this market update. Thanks again for watching. If you haven't already, make sure you smash that like button and we'll catch you on the next one. And if you haven't already as well, make sure you check out our new podcast, the No BS Property Investing Podcast. Bye for now.